Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
Imagine this. You have built a company from scratch and you have put your blood, sweat, and tears into this thing, and you have a potential buyer at the table, but the stakes are super high and this could be a life-changing event. How do you structure this deal? What types of things do you need to consider, such as valuation methodologies, post-transition pieces, all of that good stuff? So we are going to dive into this in this episode, and we have some stories. Some of them are good. Some of them are different, but we've seen this from multiple perspectives.
And I think even more than the art and science, there's a lot of emotion that people claim as art and science in both the diligence and the valuation phase of the business.
Well, I think if people go in and are trying to do fine-tune brush strokes with paint within the lines, they end up doing abstract art where they just spew the paint can across the canvas, and because they get into it, it's like their baby and they get so tied up into it.
Well, and it depends. I mean, I think Rory and I probably could use it, kind of stretching that analogy. There's been some that have been like crayons. I mean, it's not even paint. It's not brush strokes. It's freaking crayons. And interestingly, those are largely the ones where I've been called in to turn them around, because I look at the valuation and go, how did you get there? And, the PE guys tend to get, and they've been all guys, by the way. I have yet to find Rory and I have worked with a couple women in PE, and they've tended to be less emotive on their approach to things, and probably more effective, candidly. But all the guys have been like, oh no, there's this great opportunity, and it's a lot of it's pie in the sky, total addressable market, TAM. You'll hear that. It's spreadsheet stuff, and the reality just doesn't match. And I'm like, how did you get to 32x EBITDA for this business?
A private equity deal, a deal is where spreadsheets meet a soap opera TV reality show drama.
This is honest to God truth. That's the best way I've ever heard it described. Yep. So founders will ask you so what's my company worth? They have a number in their mind already. It's like somebody going to the real estate agent. We use this analogy in the book, and I use it a lot because each one of these businesses is unique, just like a piece of real estate. When you go to sell your house, you've done the comps, you've looked on Zillow, you're like, I know that this house is worth $800,000. And then you go to the real estate agent, they're going to give you a range. And if that range doesn't meet your expectation, you're likely to find a real estate agent where that range does meet your expectation. And part of this role is the investment bankers are supposed to help you with valuation, setting the expectation. That's part of their job, but they don't get to do that part unless they get the engagement. And so there is sometimes when they're talking to you about the engagement, they'll go, well, just like a real estate agent, well, I think this is a unique business and it's worth blah. And then they get in there and they go through that. And we've talked about this a few times, that preliminary diligence, and they're helping you set up the data room, and they're looking at all this stuff. They go, well, we were identifying some issues, and they may reset you. But the investment banker's job is to bridge the perception and the reality part of it. Investment bankers have a tough job. But one of their jobs is to bridge the perception of reality to expectation on valuation, and help get that deal across the finish line by getting the price up on the buy side and getting the price down and expectation effectively set on the sell side. The other part is, what's the quality of that revenue? And one of the key components is the ability to not only predict that revenue, but also recognize that revenue properly. And a lot of the businesses that we've been associated with, and I'm thinking like in Rory's case, the businesses that were specialty finance related, so like the Beelines of the world, and the business that we worked in together at Fusion Zone, we all had issues around revenue recognition. So you had deferred revenue issues. You had, when was the revenue recognized? How much in each period? And so those become areas where during diligence, if your business is generally valued on a multiple of earning or a multiple of revenue, those revenue recognition policies are going to come under intense scrutiny because it's really driving the business valuation, and you're going to want to have some of those elements dealt with your accounting team before you go to market, so that a lot of those issues end up resolved.
Yeah. So so we've talked about a lot here. So there's revenue. So there's revenue and EBITDA. There's the two big valuation methodologies, just like to keep it simple, like big buckets. Within revenue, which seems relatively straightforward, which is like take your revenue amount and say, okay, what are people in your industry in a similar category projecting or doing? And there's lots of nuance in there. So recurring revenue, I remember when we worked together at the company we worked at G2, I was in charge of the client management team. And you both told me, Emily, have your team members get people extended or renewed on these certain types of contracts, which were like legitimate contracts. They were just for a longer term, but we would kind of give in certain places because we wanted the longer term contracts. And you were explaining it to me, but now I know, having had my career now, I understand like, oh yes, because we wanted to be able to say predictably, we have this amount of revenue under contract when we were going out for deals. And so that was just for my department, my client management department. There were other things we were doing across the company with sales and operations and everything like that. But that's an example of the nuance. And the other thing you mentioned, Ed, which I think just giving these examples is good so people can hear about the different kinds of things we're talking about, is let's just say that we are both aware of an occurrence where revenue was counted in two places, meaning there were a couple different areas of the business and subsidiaries and different entities within an umbrella business, and revenue from a product line was counted in two places, and that was somehow missed and later found out, and that was a problem. So revenue recognition and how you calculate things and structure things is absolutely under scrutiny in that first revenue category. And then for the second bucket, which is EBITDA, let me just break this down to make sure that I get it and our listeners get it. Earnings before interest, taxes, depreciation, and amortization, which is basically like a fancy way of just removing all of those big, like long-term things like debt, like loans, and long-term amortization for like equipment for like 20-year long type things where you're taking a little bit year over year for 20 years. If you have like, I don't know, a tractor or something, or certain computer equipment has these calculations you do. So you're removing all of those types of things and talking about cash flow and operating cash flow. And then you're doing the similar process, right? So you're saying, okay, for companies in my industry, similar to the type of company we are, here's the type of deals that they're doing, and here's the type of EBITDA projections they're making. Is that what we've said here in our examples?
Yeah, that's basically correct. Your EBITDA is one element, but you normally have what, and you kind of alluded to it, adjusted EBITDA. So you've got EBITDA, which is earnings before interest, taxes, depreciation, amortization. Those are straightforward add backs. And then people like to add,
is where you can get creative.
You can get
you can get artistic.
Very creative. Yes, that's could be Pablo Picasso right there.
You can be Picasso. You can finger paint. You can do interpretive dance.
Jackson Pollock is probably closer to what I've seen in most of what I've worked with. But yeah, and the intention. I mean, again, this is it's not a secret, but the intention is most everybody goes, you get these one-time things. So you want to take all the one-time good things and say that they're going to keep happening. You want to take all the one-time bad things, or even some of the things that happen once in a while, and say that they're one-time, and you put those into your adjustments column. So you adjust your revenue up, you adjust your expenses down, and then everybody will look at that and most of the time discount the one times. The sellers, the founders will tend to pound on the table and go, this is absolutely one time and it's never going to happen again. And, it was a tax event or whatever. But that's where a lot of creativity comes in on adjusted EBITDA.
But here's like an interesting part. So all of these are relative to peers in your industry.
Mm-hmm.
And so I think a lot of people get confused on like the absolute value, like the number, which I mean, like, I'm trying to think of an example. Like maybe when you're looking at like stocks or ETFs or something, where like there's certain ratios that you look at on the technical side, where like, okay, that's the number, but it means nothing unless you have it in context to its category.
Right.
So like relative to what? So I think it's important to consider that. Like that's always going to be involved or included at some level in the valuation process.
Yeah, and the other piece to keep in mind is valuation headline number is not necessarily real valuation. So a lot of times you'll get, and I know we talk about this in the book. I think we've talked about this on these pods too, where you're like, well, they might say they're offering you $100 million, and when you're getting your indication of interest in to gate folks to the next round, or even choose your final diligence partner to kind of go through process with, and when you look at the actual deal structure, it might be $75 million or $65 million in cash, and then an earnout, and then a bunch of contingent payments or contingent a basket for liabilities. And so the entire deal structure needs to really be analyzed to figure out what the true economics are. Because you could say, well, I'm going to give you 10x EBITDA, which is 2 turns or 2 more times, 8x versus 10x would be 2 turns more than any other components. But then you end up with some onerous deal terms in there that make it almost apples to apples. It's just when you start setting them apples to apples and showing your cash flows and your present values and all those things, and that again is something that both the internal team, so the CEO, CFO, as well as outside counsel, outside advisors, and investment bankers need to kind of show apples to apples on the term sheets or force everybody into a equivalent term sheet in order to be able to evaluate.
And so if we're talking to like a founder, like my general approach is get a valuation you think is accurate and fair. And then also there's like the personal piece, which is like, what does this deal need to look like for you personally? And if you've got those two big rocks, then you're probably going in the right direction. Would you add?
Yeah. No. And again, we've mentioned this numerous times. Know what you want when you go into the transaction. Why are you going in? And if it's like, no, I'm trying to get some money off the table, try to diversify my holdings, but I still want to work for another 7 years, and I've, really looking forward to the bite of the apple, et cetera. Optimizing your purchase price may not be the right answer. It may be, hey, can I work with these folks for the long haul, because that's my goal, to build value in this business and get enough off the table to make it worthwhile. You go with I'm getting the highest headline price, or I'm trying to optimize my income today. You may end up, if you can't work with those folks, it's not going to work. You're going to end up out. This is not as if they've got control. You're not going to be happy, and you're going to be wishing that you had taken the lesser deal with the folks that you jive with.
And in addition to what you said, is some people are like, I want the biggest number for myself, and I'm just going to exit this, and that's my plan. So if that's your plan, then it's like, okay. And we've run into founders who like say they care about their teams and do that whole talk track, and in reality, they're out for themselves. And so, that scenario does exist where it's like, literally, how big can I make my personal number? I don't really care what leadership is in place afterward. I'm going to get mine. And so like you have all these different equations or different kind of intended outcomes that you're looking for. So know that, and we have talked about that in the past. How do you know if you're getting an accurate and fair valuation? If you're like, this is my first rodeo, I have an investment banker, I think this seems right, like gut check wise, but I'm kind of basing this on, not a lot of foundation here. What's the best way for someone to do that?
You need to have done your homework going into it. once you've kind of looked at what the comps are and you've talked to multiple investment bankers and gotten them to give you feedback as to what your company's worth. And again, the other thing that we've said over and over again is that choosing your set of advisors, your investment bankers, your accountants, your attorneys, should not be a one and done process. That should be a little bit of a beauty contest, some interviews, ask those kind of questions, you'll get some consensus around what the valuation is. And if you're off that valuation, you should understand why, high or low, going into that transaction. And so that's the best way to know it's a good deal or a fair deal on a valuation side is to have really set those expectations or have gotten, a set of expectations from various sources and then be able to triangulate that against the term sheets you're trying to evaluate.
So would you suggest 2 or 3 investment banks, or would you suggest an investment bank and other entities that would provide a valuation?
So when you're going through choosing who your investment banker is going to be, that's one of the questions you should be asking is, what do you think the company's worth? How would you go about coming up with the valuation? What are the key drivers to valuation? And is there anything we should be doing now, between now and when we go to market, or between now and when we get into negotiations, that would help us improve our valuation or improve the perception of the business to potential buyers? So you'll choose one investment banker. Once you've chosen that investment banker, you're basically mated for the purpose of that transaction. So you're not, you can go out and pay for, and you're going to pay for additional valuation information if you want to have a business valuation expert or somebody like that come in and validate your offer. And that's an option, especially if you feel like if you just aren't feeling right. There are folks who specialize in business valuation, CPAs and others that do it. A lot of times for estates or tax issues, so that way with audits to set values. So that's something you can do to check it. But in general, you should have a good idea and do that prior to going to market.
So do your research is a huge one. And then in the investment bank vetting process, you ask them these types of questions about their approach to valuation and kind of what they see. And then you choose an investment bank. Now, just to be clear, are you saying spend the money with 2 or 3 to get like an actual valuation of 2 or 3, or just ask them?
You just ask them. It's kind of like choosing a real estate agent. So they're normally an investment banker. They may have some retainer, so some portion that's pay to play, but most of them they make their money on a percentage of the sale price, and the higher the sale price, the more they make, just like a real estate agent does. So during that interviewing process, they're going to want to get that business, and that's the time to ask a bunch of those questions.
As part of that vetting process, do they give you like a rough estimate of like how they would value the company? So you have like 3 numbers to compare? Okay.
And you should be asking that question and asking what the drivers are and asking how they came to that number.
So they might not be able to like the deep dive until they get in, but everyone in that phase of things should be able to give you an estimate. If you're like, okay, like whatever, 3 or like 4 out of 5 are in this general range, and this one's kind of known for being aggressive or whatever, or creative, that might be one thing. If you're like, I'm getting like 5 different answers here, or best out of 3 type of thing, that's a.
And I don't have an IB pitch book here, I don't think, and even if I did, I probably shouldn't share it. But a lot of times when I've had an IB's pitch, they actually will give like a sheet of here's like in the last 24 months, here's all the companies that are close to comp that have transacted. Here's the seller, here's the buyer, here's the valuation, here's almost like you would get, again, in real estate, here's all your comps, and this is how we're coming up with how we think your company is going to be valued. So there's companies like PitchBook that track all these transactions, and then the investment bankers, PE guys, all these folks that rely on this information, pull that information out, and it's available for your use. And if you get 3 investment bankers, I'll put a buck on the fact that 80% or 90% of the deals that they show you on the comps are going to be laid out that way, and they're going to be the same deals. with the same calculations and same multiples, revenue, EBITDA multiples.
Okay. So it seems like, this, if we zoom out, this overall trend of having public information on things like Zillow and Kelley Blue Book and PitchBook, you can do a lot of this research yourself now, which is great. Still need kind of a specialist once you get into fine tuning and get serious about things, but there is that information out there that people should be looking at.
And the other part is the underlying components of like how fast are you growing and or how fast are they growing, and what are the other kind of subjective or even mathematical in growth, in the case of growth, discount rate, interest rate at the time at which those transacted, are all going to be inputs into how they are valued. So don't take any of that as gospel. It's a broad range, but it should give you an idea, and you should be able to triangulate a bunch of those things into my company should be worth somewhere in here. And if you're going through the process and you start falling outside of those ranges, upper or lower, you should be asking yourself why. Don't just get excited because you're falling into the upper side of the range. Understand why you're falling into the upper side of the range, because it may be an expectation that you're setting, or that, especially if you intend to remain, that you're setting that you're not going to be able to hit. If you're showing quick growth that is going to plateau, that might be a good reason to sell the business. It might not be a good reason to stay in the business if you know that you're going to hit a plateau and folks are buying on that's going to continue to infinity type of thesis.
Okay, so we've covered a lot of ground here. We've talked about revenue valuation methods, EBITDA valuation methods, know your why and know what you personally want to get out of this. We've talked about investment banks and getting a couple different perspectives there. Is there any other, and you've talked about the market conditions where like, hey, interest rates and things like that. Are there any other major considerations where it's like, okay, if someone's about to go into this part of the process for real, make sure they've got their ducks in the row over here?
Yeah, I'll touch on it. And Rory has used the term corporate hygiene, which I think is a little skeevy, but
it means take a shower in your office. No,
but the reality of it is, the cleaner your books and records are, the better presented your models are, the better organized your room is, your virtual data room, the more your team has rehearsed the meetings so that they riff off each other well. That all goes into valuation. Those are all the subjective pieces. And I teach finance at local university, so I a lot of it is math, and Rory talked about the math. But the key on even on the math, for the math nerds, you've got a risk-free rate and a risk premium. And so the sum of those two is what you discount your expected future cash flows at. Rory kind of hit on that with the EBITDA piece. That risk premium comes down if there's a perception that this is a less risky trade, because all this stuff seems really wired tight. And so there's less unknowns and less known unknowns and unknown unknowns, my friend Don Rumsfeld would say. And so when your discount rate comes down, your valuation goes up. And so as a result, going into this, make sure you've got your books, records, virtual data room, pitch, all that stuff down cold, and it looks right, and it is right, so that you don't raise risk flags, which will then drive the risk premium up and then drive your valuation down.
Yeah, I think that's a good point. It's kind of like a loose equivalent to taking the time and spending the money to stage your house for people to come look at it. Because if you just have an empty room, it's like, okay, like the math works out, but this is just like a bare, empty, gross room. Whereas if you're like, oh, like the sofa could go here, and here's the fireplace, and here's how you could make it look, interior decorations. And it was funny. I had a coaching client who was a original founder and CEO of a successful business going out for their next round of funding. And he was like a nerd through and through, just like a technical nerd who could code, who was a genius. And yes, he was from India, so he just like hit all the stereotypes and everything. And he was having trouble giving his pitches to investors because he was just such a technical nerd. And so we worked on a couple different things, but one is like speaking at a level that your audience is going to understand. So having that like polish, but also understanding where your audience is coming from, and that fine balance between delivering information that is relevant and helpful to them, that's at their level without being condescending. So kind of threading that needle. But he was such a nerd that you couldn't get over the fact that he like, oh my gosh, like this is not what we call a people person. He just would nerd out on things. So we made a joke. So I said, okay, open it like this, like open it like, hello, I'm from so-and-so company and my name is, and he had this Indian name, short first name and super long last name. And he would kind of say it and stutter and say, I hope I said that right. And just get a little laugh out of people. and then he would literally say like, I'm a tech nerd, but I'm going to try to be around people now. And so everyone kind of knew, okay, here's what I'm getting into. But just for him in that setting, that worked for him to be able to connect with people. But whatever your situation is, find what's going to work for you and your team in these settings. A lot of founders are like the opposite, right? They're like the flashy kind of gregarious, like, hey, I could talk to, dry paint on a wall, and I could carry on a conversation with the chia pet type of thing. So sometimes it's the opposite problem, but I would definitely agree. Just make yourself prepared and make it so it's polished for your audience. All right. Final call for valuation methodologies and going into this dramatic spreadsheet TV soap opera deal.
I know poor Liebhart's having technical difficulties, which is just
We've got to see his dog though on his couch a couple times.
We did. That was pretty awesome. The biggest thing, and we do have stories. We didn't get to tell them because Rory's the best storyteller of the bunch. And so we didn't get a lot of stories, but I will say this: the valuation piece, as you go through that process, is setting the table for the entire PE hold period, because the only way they make money is if they make money on the investment, and most of the money in the investment, they'll tell you it's in the execution, but it's like anything else, you make most of your money on the buy, and so that buy valuation is absolutely critical for the private equity piece. And if they overvalued, regardless of how nice a guy you are or how nice a gal you are, they are going to get very irritated if they figure out they overpaid, and they're not going to hit their return hurdles, even if you're doing fine. But fine isn't fine enough for them. And on the flip side, if they underpaid, they're going to be ecstatic and you're going to be irritated. So there is a kind of a fine point of trying to get to the right answer. Like I said, most of the deals that I've had to go into are ones that were just grossly, like the last one was just grossly valued, grossly off. I'm not going to say misrepresented. I don't want to get in trouble. I would just say the valuation was significantly higher than I would have paid for it, but so are most private equity transactions. And you end up spending a lot of your time trying to scramble to get the return that was underwritten originally. And I'm dealing with another one of those right now, where I did the valuation as underwritten, and then I showed what the valuation is today, and it was a very eye-opening presentation for the private equity folks as to what just a couple changes in assumptions over the last 2 years have done to their investment thesis. So those are the kind of things that, that initial valuation is going to set the table for the entire hold period and set a lot of the attitudes and emotions during that hold period. So just be prepared, and that's probably the most critical piece of the entire deal process, is getting that valuation right.
Set the table right. That can be our takeaway message. I was trying to think of something clever for like a reality show where like it goes well. The only thing that's coming to mind is like The Bachelor, because that's what I watched in college. But less tears, more roses. We'll leave it with that. There we go.
Beautiful.
We'll catch you next time on the Private Equity Experience Podcast.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.